Well, February was the first month in 2 years that ETFs had outflows, but beneath the surface, a lot of the movement had more to do with rate fear than volatility, perhaps surprisingly. Here to discuss is Eric Balchunas, senior ETF analyst at Bloomberg Intelligence. I mean, this is really interesting because the thinking is that the blow up in those short vol ETFs is what kind of triggered the increased volatility and the sell-off. But we almost forget that it was the jobs report with the higher wages that also spurred a sell-off on the Friday before.
Listen, XIV cannot hold a candle to rising rates. Rising rates, I call it the invisible hand, really behind most of the ETF flows. Yes, SPY does its 10 billion in and out, and that makes up a large portion of all ETF flows, so people think it's a stock thing, but that's getting more operational flows and traders. If you look at fixed income, this is where the action is. Fixed income ETFs in February took in 1 billion. All right, that's like sleep-inducing, no big deal. But when you unwrap that number, you got a lot going on. You had a 9 billion swing from corporates to treasuries. You had a $7 billion swing from high yield to investment grade. And you had a $5 billion swing from long-dated stuff to short-dated ETFs. You can see from the chart there, that is a lot of movement. It sort of reminds me of the taper tantrum days when you had this much, remember the duration rotation and all that? There's something going on here. It was symbolized by LQD. LQD is an investment-grade corporate bond ETF, but its duration is 8 years. So look for this one to key off of rates, right? That's a long time, 8 years. People are either rotating down to something lower or they're going to something like SHV, which is essentially cash. That's 1 to 3 month treasuries. That was the second biggest flow getter on the fixed income side. And of course, high yield debt has been getting clobbered. Right. I think 3 or 4 billion out in the past month, but a little bit trickled back in because that rate rise kind of stopped. But the sensitivity between HYG and LQD is really, those are the ETFs to watch on the fixed income side for rate concern.
Yeah, a lot of risk aversion, too, as evidenced by those moves. If you look at the equity sectors, of course, you have a lot of rate sensitivity there also. So did the flows reflect that?
Yes, the sector ETF flows were all over the map. Normally you have like 8 up and 2 out and materials are down because gold is bad. This was all over the place. It was like everybody threw everything up in the air. But what stuck out to me was REITs seeing 1.2 billion in outflows. That continues a bad January. Here's the thing. REIT ETFs were way bigger than they really should be. They're the biggest sector by assets in terms of ETFs, and they're not that big. And so that's why passive, the average REIT stock is 25% owned by passive. That's almost double the average.
Why? But wait, take a step back here. Why are they so big?
They yield 6%.
So they just in this low yielding, first yield environment.
So on the stock side, look for REITs. Here's the thing, though. Back in 2013, back to the taper tantrum, REIT ETFs saw 2.4 billion in outflows that month when the taper tantrum started. They only saw 1.2 billion in February. In other words, it could get a whole lot worse. If that 10-year climbs to 3%, look for REITs to get clobbered. They're already down about 12–15% since November, and that rate climb started. And utilities also seeing outflows as well. So rates are really everywhere.